Hi, everyone. This is Kathy from the Swindells Center. Just want to welcome you tonight to our training. We'll be starting in about 5 minutes, right at 6 p.m. So find yourself a nice comfy spot to sit and maybe something to drink while you're waiting. And we should be starting in just a few minutes. Hey everyone, this is Kathy again from Swindells Center. If you wouldn't mind like putting into chat where you're watching this from, where you're going to be viewing from, what part of the state you're in, and maybe add in like what kind of weather you're having over there today. It'd be kind of fun to see if we're really reaching out to the whole state today, and or maybe we have some of our own neighbors here from our own areas. Thank you. Okay, we're going to go ahead and get started. Good evening, everyone, and welcome to the Swindells Center Remote Education. I'm Kathy, and I want to thank you all for joining us here tonight. To those of you who are new to Swindells, we're a resource center that offers support and resource information for families, providers, and educators of children with special health, developmental, and behavioral needs. And in addition to trainings like this, we have an online lending library that can be accessed on our website. If you plug in Swindells in any search engine, it'll pull up our website, and then up on the upper right-hand corner, you can access our library. We also have a free care notebook, which is a really handy tool to maintain a health record for your child and keep all the important documents like IEPs, evaluations, upcoming appointments, things like that. And also there's a spot for business cards all in one handy place. So for busy families, when you need to just run out the door and have all that information, you can just kind of grab it and go. And we're happy to mail the library books and the care notebooks directly to your home. And those care notebooks are free of charge for families. Please call us or email us if you'd like to request library books or care notebooks, or if you'd like to be put on our mailing list for upcoming trainings and resources, and we'll add our phone and our email in the chat box. So tonight we're offering information about the ABLE account, and our speaker is Kaylin Hessel from Oregon Treasury Savings Networks. So we'd like to thank Providence Children's Health Foundation and all of the really generous donors, and also we'd like to thank the Oregon Treasury Savings Networks for helping making this event possible tonight. So before we get started, I want to go over just a few housekeeping items. So as a healthcare institution, we're really concerned about your privacy and want to help protect it. And we have many measures in place to protect your privacy tonight. So this event will be recorded, but we will stop the recording when the question and answer period starts. If you have a question or a comment, or if you're experiencing some type of tech issue, just please submit that in the Q&A section. We will be addressing questions at the end of the presentation. So please add your questions to the Q&A, and then we'll direct them towards Kaylin at the very end. And finally, you will receive an email after the training with an evaluation, and upon completing the evaluation, you'll be sent a certificate of attendance. So please join me tonight in welcoming Kaylin to our stage. Thank you.
Great. Thank you so much for having me, and for everyone who's attending. I really appreciate you taking the time out of our busy, crazy lives to talk about Oregon Able Savings Plan and how it can help your families. So we'll cover basically everything you could ever want to know about Able. But as I said, feel free to shoot us over questions when you have them, and we'll get to them at the end. Okay, so first, why does this program even exist? There are many state and federal benefits out there that have an asset limit, usually $2,000. And if somebody receiving one of those benefits, has more than 2,000, they lose those critical services. So this was functionally forcing a lot of people with disabilities to live in poverty to get the services that they need. Congress eventually figured out that was not the best idea they've ever had. So back in 2014, they passed what's called the Stephen Beck Jr. Achieving a Better Life Experience, or ABLE Act. So that allowed for states to create these ABLE savings plans and for people with disabilities to save money in an ABLE account and not have it count against asset or resource limit for any state or federal benefit. So the big ones are SSI and Medicaid, but this also includes SNAP, HUD housing assistance, anything with an asset or resource limit, including FAFSA. Money in the ABLE account does not count on the FAFSA when you're applying for financial aid for college. So it's a really powerful tool, and we have, I want to say, about 3,500 savers. Oh gosh, and they've saved, I want to say it's close to about $20 million so far. So this is successfully working for thousands of people all across the state. Yeah. My favorite part about Able, though, is that from the very beginning, it was designed to be a self-empowerment tool for people with disabilities. And this comes through in a number of different ways. So first, the person with a disability is the beneficiary, which in this case means they are the person benefiting from this account. But they're also legally the account owner. So everything that is in the account legally belongs to them, no matter who is managing it. And so for those of you who have kids, the money, is supposed to be for the benefit of your child, but as a parent or a guardian, you're going to be the one managing this account. But when your child becomes an adult, it is legally their money and they get to decide who is going to manage it. So we designed this program with the presumption of competence. We're assuming that all of our savers are going to be able to manage their accounts independently, but we know that this is not going to be the case for everyone. But we thought it was important to start with this and then come up with some plan Bs. So there are other people who can manage these accounts. We call them authorized legal representatives. So that includes parents of minors, guardians, conservators, someone with power of attorney. So if there's anyone else like a sibling, spouse, rep, payee, the only way that they can manage this account is if they're given power of attorney. We have a form on our website for that. It's not as complicated as it sounds. You just fill it out and get it notarized. But while your child is under 18, you'll be managing it for them. And later in the presentation, I'll talk about what happens during that critical transition period to adulthood. So whoever is managing the account gets to self-certify some very important information. And this is one of the things that makes our program unique. At Able, we essentially say, here are the rules, and the people managing the account say, to the best of our understanding, we're following the rules. So you actually get to decide if your child is eligible for one of these accounts and if they're using it for an eligible expense. That makes it so much easier to open and manage an account. It means that you don't have to wait days, weeks, or months for us to go through diagnosis and doctor's notes to see if your child does actually qualify. And it means you don't have to ask our permission in advance. You don't have to turn in receipts to us. You can just take money out when you want to spend it and then go spend it. But as you can tell, there's a lot of trust built into this. So when the ABLE Act was passed, it officially changed the US tax code. So that means it is up to the IRS to make sure that everyone is following the rules. Now, they've assured us that the chances of them auditing or investigating someone with an ABLE account is no different than any other taxpayer out there. So this is one of those things that is not very likely. The IRS is notoriously understaffed and overworked, but it's good to follow rules. We definitely recommend not messing with the IRS. So it's a good idea to have in a folder somewhere, a diagnosis, a written diagnosis, those receipts, so the IRS has an idea of how you've been using your account if they ever end up asking about that. All right, let's talk about who qualifies. There's two main criteria that someone has to meet. First is age of onset, second is severity of disability. So age of onset means that somebody's disability started before the age of 26. Sometimes, most of the time, this can be clear, but other times it's a little complicated. So let's say someone is diagnosed, with autism at 27. We know by the nature of that condition, they've always had it. Doctors didn't know what to call it until that person happened to be 27. So that individual would also qualify. And then the second criteria is the severity of disability. So your child's condition needs to impact them enough that they qualify for SSI or SSDI. So if they're currently receiving one of those, it's clear that they are eligible for this. But if they don't, because your family has too many assets or too much income, that's okay. You can still open an account for them, as long as their condition, their disability itself would qualify them for this account. And since you're the one who decides if you meet the criteria, you just check boxes saying that it does. If you're not sure, if you want to be extra sure that your child qualifies, you can get what we call a disability certification form signed by your doctor. There's one on our website. You can print it out, take it to your doctor. They can sign off on it. Or if you have like a written diagnosis already in your files, you can just use that. What can this account be used for? So the actual US tax code includes the following things you see on the screen. You've got education, housing, basic living expenses, transportation, employment training and support, assistive technology, personal support services, health prevention and wellness, financial management, legal fees, funeral and burial costs. But thankfully, when Congress wrote this law, they realized that each one of us is different and has a different idea of what we are going to need to live, the quality of life that we've been dreaming about. So they didn't want to leave out something that would be important to any one of us. So they actually included this and more to make this all very open-ended. So the most important thing to remember is that you can use the account to pay for anything that improves the health, independence, or quality of life of the person with a disability. We call these things that you use the ABLE account to pay for disability-related expenses, but sometimes it doesn't have to directly tie to their disability. Like everybody needs food, whether or not you have a disability, and you can use this account to pay for food. So if you're wondering if this is an eligible expense, I encourage you to ask yourself, will this improve my child's health, independence, or quality of life? And am I comfortable maybe one day explaining that to the IRS? If the answer is yes, you can go ahead and use the ABLE account to pay for it. So let me give you a couple examples. When the law was first passed, all of the states came together to figure out what's this new thing we're supposed to be doing. So they had someone from the IRS come and explain it to them. And there was a woman in the audience who didn't like how vague this was. She wanted them to list every single thing that counted, every single thing that didn't. We tried explaining to her that that was a terrible idea because they would mess it up. Don't ask questions like that. Don't make them do that. But she couldn't let it go. So she asked, well, I can't use this account to go to Disneyland, can I? And if you look at that list, vacation's not on there, Disney's not on there. But as the gentleman from the IRS said, Disneyland's pretty fun. That's going to improve your quality of life. So yes, you can use this account to go to Disneyland. And she said, well, can I use this account to bring someone with me to Disney? He said, yeah, like some people are going to need a level of personal support. Or, you have a small child, your toddler can't go to Disneyland without you. So yes, it can be used to help pay for that. She's like, well, I can't use this account to bring like 12 people to Disneyland, can I? He's like, no, okay, that is going too far. Cannot bring 12 people to Disneyland. So another important thing to keep in mind is that whatever the money is spent on is supposed to be primarily benefiting the individual with the disability. If it happens to benefit other people, that is fine, as long as it's mostly for the individual. So let's say you're taking your toddler to Disneyland. Like you get a trip to Disney, and that's pretty cool. But you're doing it for your toddler. Your toddler is way more excited about all the rides and meeting the princesses, and you're probably much more aware of, standing in line and the not so fun stuff. So you happen to benefit, but it's mostly for your child. Another example, let's say a family has a child who needs a wheelchair to get around. And because of that, they need a wheelchair accessible van, which is very, very expensive. And even though the whole family can fit into the van and go place to place together, they're benefiting, but it's mostly related to the daughter's disability. They have that extra expensive car. They would have had a much cheaper sedan if they didn't need to be wheelchair accessible. So they're able to use the ABLE account to help pay for some of those additional expenses. Yeah. All right. So when you take the money out of the ABLE account, you can move it to a checking or savings account, and you can keep it there for as long as it takes to go and buy the thing you are going to buy. So, if your kid is buying a car in the future, that process can take a while. So that's no problem. There's no time limit on that. The exception is if someone is receiving SSI and wants to use their ABLE account to help pay for their housing expenses. If that is the case, we recommend taking the money out of the ABLE account and spending it in the same calendar month. So if rent is due November 1st, don't take out the rent from the ABLE account at the end of October, take it out November 1st and spend it then. That's because at the end of each month, Social Security comes and checks those checking and savings accounts. And if they see a large amount sitting in there for housing, it raises a red flag for them because they are under the belief that they have given people enough money to pay for their housing, which is usually not the case. So you're absolutely allowed to use this to pay for housing. It's just easier for everyone to keep those expenses within the same calendar month. Like I said before, this is only specific to housing and SSI. If it's any other benefit, any other type of expense, you don't need to worry about this. There are some limits you should know about. You can have one account per person. The most that goes in there in a single calendar year is $15,000. And that money can come from basically anywhere. It could be money from parents, it could be from extended family. If your teenager is working, they can put in some of their paycheck, leftover funds from Social Security, back pay, inheritance, settlements, all of that can go in there. But the most that goes in 1 year is $15,000. But on January 1st, you can deposit another $15,000. The most that can be in there overall is $400,000. And the most that can be in there before SSI is affected is $100,000. So when people sign up for the account, we ask, are you receiving SSI? So we can warn them when they're getting close to hitting this limit. If somebody ends up going over that $100,000, the amount above $100,000 counts against that asset limit. So if you have $100,005, it's just the $5 that counts against the SSI asset limit. If you end up being over-resourced, the SSI benefits are suspended, but Medicaid, everything else will continue. And then once the money in the ABLE account dips back below $100,000, SSI will resume. So there are some fees you should know about. The first is a $35 annual flat fee. That comes out of the account quarterly, and it's prorated. So every 3 months, I believe it's $8.75. And since we're coming up, gosh, at the end of the year, we're not going to charge you for a whole year. We're just going to charge you for the amount of time you've had the account open. There's also an annual asset-based fee. So this is between 0.3 to 0.35% of what's in there. It's less than 1%, which is very good for an investment product like this and other ABLE programs that are out there. But we know that these fees are still difficult for some families. So know that we're only take what we need, what we're needing to keep the program running, and we're doing everything we can to lower those fees as quickly as we can. So there's also a chart on there that explains a couple other fees. These are fees that tend to happen when something special happens. Like if you bounce a check or if you need us to overnight you something, there's pretty much always extra fees for that. So the only one I want to highlight is the paper statement delivery fee. If you want us to mail you paper statements, it's an extra $10 a year. We really encourage everyone to manage their account online because it keeps our costs down so we can keep your costs down. But if you want us to mail you paper, we can do it. You can also log into your account, print it, put it in that filing cabinet for free. All right, so there is a new provision called Able to Work. So if your loved one is old enough to be working, maybe the teenagers are getting their first job, they're able to save more than that $15,000 a year. So they can save an extra $12,490 or the total of their wages, whichever is less. So if they make $5,000 a year, they can save an extra $5,000. If they make $30,000 a year, they can save an extra $12,490. Now, when you put money into the ABLE account, we ask, is this a standard contribution or is this an Able to Work contribution? That allows us to track them separately to make sure that we're giving you access to save as much as you're entitled to. But I want to point out that it's only the beneficiary, so the individual with the disability, who can make an Able to Work contribution. If a parent is managing the account and they're working and they want to put in funds, that is great. You can do it. It just has to go in that standard contribution bucket. And I also want to point out that any wages that are added to the ABLE account they're never going to help with any income limits that a benefit might have. So benefits usually have an asset limit, an income limit, or sometimes both. Asset or resource limit is what says I can't have more than $2,000 in my accounts. The income limit is what says, we can't work more than this many hours or earn more than this much money. So the ABLE account can help an individual hold on to more of their paycheck, but unfortunately, we can't help them work more hours. All right. So you're also able to now roll money from a 529 college savings plan into an ABLE account. So in Oregon, our 529 is the Oregon College Savings Plan. And my division at State Treasury also manages that. We've been doing it for about 20 years now. And since we do both those programs, if you want to move money from Oregon College into Oregon ABLE, we don't charge any fees for that rolling that over. One of the biggest benefits for doing that is, if your family is concerned about asset limits, or that could be a problem once your child turns 18, but it could still benefit you to do that, even if that's not a concern. So the money in the Oregon College Savings Plan can be used to pay for tuition, room and board, books, computers, for like four-year institutions, two-year, but also community college, trade school. The ABLE account can be used to pay for so much more. It can be used to take the bus so that someone can get to school. It can be used to pay for any assistive technology that they need, any tutoring. So it really allows an individual to have access to any of the other resources that they might need to be successful in school. And like I said earlier, the money in the ABLE account does not count on the FAFSA. Money in a 529 college savings plan does have a small impact on the FAFSA. It's small, it's not too bad, but no impact is definitely better than a small impact. What gets rolled over from the college plan into ABLE does count against the annual contribution limit. So that's at $15,000 a year. You're not going to be able to move more than that over each year. And the other thing to keep in mind is that the ABLE beneficiary also must be the beneficiary of the 529 or like a sibling. So for instance, let's say family has two kids, oldest goes to college, gets a full ride, doesn't need the college fund. That's great. They can roll that money into the younger sibling's ABLE account. And then that'll allow that sibling to pay for their higher education costs. Or if, a medical expense comes up and they need to use it sooner, they'll also have the flexibility to do that. We also offer a prepaid card. If you think about a reloadable gift card, that'll be the most similar thing. You sign up for this card, you decide how much you want to put on there, and then it can be used anywhere that accepts Visa. So that'll be most websites and most, checkout counters. And once you've spent the money that you've put on that card, you're cut off. You can't spend any more money until you reload it. So for those of you who have teenagers, or you almost have a teenager, this can be a really helpful tool during that transition period. You as the parent could be managing the account, and you can sign up for a prepaid card in their name. This lets you put their allowance, their spending money on the card, so they can go out and start practicing their financial skills. And an important part of learning about how to make good financial choices, it will involve making some financial mistakes. That's just how humans learn, and we have all been there. But there's some guardrails built into this plan. So let's say your child, you put $50 on the account, on the card, they go and they spend it, and a couple days later they're asking for more money. You'll probably say, like, where did you spend it? Where did it all go? And like the teenagers could be like, I don't know. Like, it could have gone anywhere. So you can actually log into the card and see a list of every place that they've swiped it. So then you can have a conversation like, you went to Starbucks every day and you spent $5 on really fancy coffee. Is that how you want to manage your money? Or do you want to save some of it to get that, fancy new phone you were telling me you wanted? We're fine with either of those decisions, but it helps give you the information that you need to have those kind of conversations. And the card also allows you, the parent, as the person managing it, to set extra limits. So let's say the card is only supposed to be used for your teen to buy groceries. You can narrow it down that far. You can say, don't let them use it at certain stores, certain websites. Don't let them spend more than a certain amount of money each day. It's very flexible to meet your family's situation. So I think it's pretty cool that way. We realize that not everybody is using an account, for their daily expenses. Some people are saving up for bigger ticket items like getting an apartment or down payment for a house one day. So that we decided to only charge a fee for the who would be using the card instead of wrapping it into the fees overall. And that is an extra $1.25 a month. whether or not someone's actively using it. So I recommend only signing up for the card if you think you will be spending money on a regular basis, because nobody should, pay extra fees if they don't need to. All right, another cool feature is our online gifting page. This works most like a Kickstarter or a GoFundMe. You log into your account, we help you set up this web page. You can send the link off to family and friends, and then they can click on it and directly put money into the Able account. It's a really easy way for them to contribute, and it's perfect for holidays, birthdays, milestones like graduation, or if, let's say, one day when we can travel again, a fancy school trip is coming up. It allows your community to help contribute to that as well. Yeah, it's as easy as I'm making it sound. I am personally jealous. I wish my bank account had this, but it does not. So I hope that you will also find it helpful. So there are also tax benefits for using this account. When you put money into the Able account, you choose to either save or invest. Either way, there is the possibility that the money in there might grow. All of that growth is free from both state and federal taxes. And there is also an Oregon state income tax credit for anyone who contributes to the Able account. So if you put in money, your parents put in money, your neighbor puts in money, you can all take this tax credit. So it is refundable up to $300. That means that you actually would get $300 back on your taxes. And it's progressive. So that means that it has more of an impact on our low to moderate income savers. So if you're in one of the low income categories, for every dollar you put in, you'll get $1 back on your taxes up to this $300. But as you move up the income scale, it becomes every $2 you put into the account, you get $1 back on your taxes. If you go to our website, OregonAbleSavings.com, and click on the FAQ, you can get that full chart that explains the tax brackets. And you can also find tons of other really useful information. All right, so some of you might know about special needs trusts. These are another tool in your toolbox. So I want to do a quick compare and contrast. Special needs trusts allow also for money to be saved and to not count against an asset or resource limit. But since there's a trust, that means that there is somebody else serving as a trustee who is managing the account, approving expenses. So every time you want to take money out, you have to go to someone else, say, can I have money this much for this thing, turn in receipts. There's more oversight, which can be helpful in some situations, but in others, it can just be more of a pain. It really varies. And then with an Able account, like I said before, it's the individual with a disability who is managing it, or parents while they're kids, or somebody else that falls in that authorized legal representative category. Trusts also can have limits on what can be purchased. They usually won't pay for things that SSI is supposed to be paying for. But like I said before, Able can pay for that stuff and so much more. One of the best parts about trust is that there are no limits on how much money can go in there or be in there overall. So let's say your family gets an unexpected windfall of $50,000. We can't take all of that at Able. We're just not allowed to. So you can put $15,000 in the Able account, and then you could put the rest into the trust. And you can write the trust to say, every year, move this much money into the Able account, and that'll remove some of the strings, make it easier for you to access. One of the downsides for trusts are that they can be expensive to open and maintain. It can cost, thousands of dollars to do that, which put them out of reach of a lot of families. So our $35 fee and our small asset-based fee has really opened this opportunity up for more. There is this concept called Medicaid repayment, recovery, clawback. It has a couple different names. I'll explain it more in a couple minutes, but that applies for some trusts. Let's say I want to open a trust with my money for my benefit. That would be a first party trust, and Medicaid recovery would apply. If I want to open a trust for my brother's benefit with my money, that would be a third party trust and it would not apply. The main takeaway is that both of these programs are great, and you can have both. They can work really well together. You can use the ABLE account to save up to pay for the expenses to create a trust. You can move money from the trust into ABLE, and it really just varies on a family situation, what you might need or want and when. All right, so Medicaid recovery is a little complicated, so bear with me. There are certain services that Medicaid pays for that once a person who has received those services dies, they ask to be repaid for a portion of the cost that they have paid for. And these are more of the long-term care services, like if somebody ends up in a nursing home. But it gets complicated, what counts, and there are a lot of nuances. I'm definitely not an expert in that, so I don't want to go into more detail. But we heard from a lot of people that was a barrier for them saving. And I'm at Treasury. We want to remove barriers to savings. So a couple years ago, the state legislature passed a law that said that Medicaid recovery would not apply to any funds that had been in an ABLE account. So we thought we got rid of this, but again, it's complicated. Medicaid is funded by both the state and the federal government. So the federal government had a say and they disagreed. So we're in this kind of tricky gray area where essentially, you know, there's a state law saying that Oregon Medicaid cannot recover these funds. The federal Medicaid says they don't have to, but they can't officially write down that they will not do it. So I have to tell you all that they might do it, which is not very helpful for long-term planning. This is one of the biggest concerns of our industry and our program. We're trying to get more clarity and get an answer that's going to, last longer than whenever the federal administration switches. But there are some things that can be paid for with the ABLE account before Medicaid recovery would ever apply. So let me walk you through that. So this is what happens when an account owner passes. Their family, the executor of their estate, will provide us with a death certificate. Then they'll have access to the account, and it can be used to pay for any outstanding expenses. So, any qualified expenses that still need to be paid can be paid, and can also be used to cover any funeral and burial costs. Those are expensive. So if there's anything left at that point, it gets transferred to the estate of the beneficiary, and then Medicaid might ask to be repaid. If you want to learn more about that, you can go to DHS's website and look for the Estate Administration Unit. You can call them and they should be able to explain it to you. All right, so let's talk about something a little bit more exciting, what happens when our kiddos become adults. So like I said earlier, when they turn 18, they legally own everything in the account, and it's up to them to decide who's going to manage it. So they have a couple choices. They can now manage the account themselves. They can have the person who was managing it continue to manage it. So that was probably parent, guardian, grandparent, or they can have someone new manage it. But no matter what, if someone else is managing it, that person will either need power of attorney, guardianship, or conservatorship. In Oregon, you can't give somebody power of attorney until you're 18. So we give you a few months after that birthday to make that decision, return forms to us. And if that doesn't happen by the deadline, we have the ability to freeze withdrawals. The money will still belong to your kid. It will still be safe and protected. We're just trying to get, your attention and make sure that we're only giving access to the account to the people who legally should have access to it. So I mentioned before that within the account, you can choose to save or invest. If you're just looking to save, that would be our cash option. It's most similar to a checking or savings account. It's FDIC insured, so that means that the federal government is guaranteeing that the money that you put in there is going to stay in there until you take out. And it does have an interest rate. So there's a possibility that it might grow a little bit, but it is tied to the federal interest rate, which currently is 0. So it's not great at the moment. But before the economic downturn, it was actually one of the better interest rates I've seen. I want to say it was around 2%, and my own bank account was 0.2 or 0.02%. So it was one of the few times in life that 2 actually seemed like a big number. So as the economy recovers, as the federal interest rate goes back up, so will this one. But no matter what, there's the guarantee that you will not lose any money in that option. The other options are investment options. And with investments, there's always risk. The names of each of those options match up to the amount of risk in each one. So conservative option has a conservative or a small amount of risk. So there's a small chance you can make more money, small chance you could lose some of those money. Aggressive is a lot of risk. So you'll see the account go up and down more. Moderate is a medium amount of risk. Now is a good time to mention that I am not a financial advisor, so I cannot tell you which of these options is going to be best for your specific situation. But what I can do is encourage you to think about a couple things. Consider how you're using this account. Are you using it to pay for everyday expenses, or are you saving up for something that you won't pay for 5, 10, 20 years from now? The amount of time that you're saving has a big impact on a person's investment choices. If you think of a retirement plan, when someone is just starting out in the workforce in their early 20s, they tend to be, if they do the automatic retirement option, that's tied to like the date of when they're going to retire. It starts off very aggressive, but as they get closer to retirement, it becomes more and more conservative the closer that they are to using it. And the other thing to consider is what's called your risk tolerance. So basically, how comfortable are you with the possibility that you might lose some of the money that you put in there? If if the idea of losing even a little bit of the funds is making you sweat or scaring you a little bit right now, if you were to put that money in the aggressive option, that's going to give you a lot of heartburn. So for someone like that, even if you are saving for a long time, the cash option or the conservative option would probably give you less heartburn. So you want to kind of factor in both of those things and how important each one of those is to you. So if you go to our website, you can dive deeper into each of these investment options. The chart below shows a mix of the different market index funds that make up each one of them. So feel free to dive as deep into that as you want, but what you see at the top of the slide, that's really the choices you have. So if you decide that you only want to save, you can put all of your money in the cash option. You can put all of it in one investment option, or you can split it between cash and one investment. And you will not be stuck there. You can change your mind and mix those up or reallocate them up to twice a year. All right, so let's say you want one of these accounts. What do? You're going to want to go to OregonAbleSavings.com. Do not go to your local bank or credit union. The only way to get an ABLE account is from one of the states who offers them, and we all do that online. If you're serving as an authorized legal representative, you're going to need to give us a copy of that guardianship or power of attorney paperwork. But if your kid is under 18, you don't have to give paperwork for that. Just if they are over 18, you'll need to provide that. We also strongly recommend attaching, a traditional checking or savings account that you might have at your local bank or credit union. This just makes it so much easier to move money in and out of the account. It's just, you can do an online banking transfer from one to the other. If you do that, it can take 3 to 5 business days to move money from the cash option into your checking account, or vice versa. Moving money from one of the investments back into your savings or checking account takes a couple extra days. It's more like 5 to 7 business days because we have to actually go and sell that investment, convert it to cash, and then send it over to your bank. When you open the account, you're going to want to put in at least $25 as well. So this slide is a good one to maybe take a screenshot of. It just walks you through the process of opening an account. Step one is getting, together the technology you need, important information like social security numbers, tax ID numbers, date of birth. We're going to ask a little bit about the disability. And then if you're attaching that bank account, you're either going to need your username and password or the account and routing number. Go to OregonAbleSavings.com, click open an account, fill out the form, attach the bank account, transfer at least $25, and then you're done. It takes most people about 10-15 minutes. There are a couple exceptions. So if the person with the disability is over 18, they have someone else managing their account, they have to turn in that guardianship or power of attorney document. And that means someone on our end has to read it and make sure that this is a real legal document and not some random thing you sent us. So it can take a couple extra business days for that. There's also a portion of the process called Know Your Customer. So legally, all banks these days need to know who they're doing business with. And that means they have to verify our identity. So there's a section of our website that asks questions like, which of these companies have you worked for? Which of these counties have you lived in? And what they're doing is pulling information from the public record about you to make those questions. They're getting stuff like from employment records, rental histories, credit histories. And for many people, they're able to get through that check just fine. But we know that for a lot of our savers, more so if an adult with a disability is opening an account themselves, they might not have as many of those histories. So then there's not enough information for us to create those questions. So if that happens to you and you get some kind of error message there, it tells you to call our call center and they can walk you through a separate process. But I know that that can freak some people out. So let me assure you that it is not bad. It is, you just fill out the paper version of the form and you mail it in with a copy of like a state photo ID. So it's all of the same information you would have been providing online, but then we check it through a manual system. And when that is done, you're able to manage the account online just like anyone else. And this is checking the identity of the person who's managing the account. So, let's say a parent is managing it for their child under 18, it won't be checking the child's identity. Obviously they don't have a credit score. It's going to be checking the parent's identity because they're the one who will have access to those funds. Right, so that is everything that I wanted to say. And so ready to open it up for questions, but first I want to click over to this slide so that people who have the recording also have my contact information. It's kaylin.hessel@ost.state.or.us. Feel free to reach out whenever you have questions, problems, concerns, suggestions for what we can do better. We definitely are very open to all of that and are just trying to provide you all with the best plan that we possibly can.
Okay. Are you ready for a lot of questions? We have some great questions here for you, Kaylin.
Yeah, I kept seeing notifications pop up, so let's do it.
Okay, no less than 15 questions. How's that? So anyway, first of all, we're just curious if the slides will be available after the presentation, if we can send them out.
Yeah, I'm happy to send those to you.
Great. Okay, that's perfect. So there's some questions about the fees. So where do the fees go to, and why are there fees associated with these accounts?
Okay, that is a good question. So first, let me start with the why. So when the legislature created this program, they wrote into the law that we have to be self-sustaining. So that means that we have to generate enough revenue to cover our expenses. But when they started, they gave us a loan, since we were a small little startup to get us going. But we don't receive any money from the general fund. All we receive is those fees. And I know that this, can be tricky, but I think in the long term, it'll actually work out to your benefit, since we don't take any money at all from the general fund. And every time there's a budget crisis, the general fund is, in danger. You have a lot of people fighting over that money, and there are always risks that programs that you rely on are going to be cut back. But since we're not receiving any of that funding, we don't have that risk. So the fees end up paying for the outreach that we do. We actually contract out with a private bank to do the day-to-day management of this. They're the ones who actually take care of your money, run the website. So we have to pay them as well. It helps pay for our salaries so we can, do problem solving for you, so that I can come and explain the program to you. But we're taking as little as we can. Yeah.
Okay, so I think this was covered, but so this can be opened over the phone, and or is there another way to open the account? And also, it cannot be opened at a bank or credit union. Is that correct?
So you cannot open it at a bank or credit union. It's through our website or with the paper form. You can find the paper form on our website, but I can also, mail someone a copy if you don't have good computer access. And then if you want to manage the whole thing offline, that is possible. It makes it not quite as convenient, because then you have to call our call center and ask them to make a withdrawal, make a contribution. And it's just an extra phone call instead of a few clicks, but you're absolutely able to do that.
Okay. So you mentioned that there's a prepaid card. So is that as well as like a debit card, or is that something different?
So there is no debit card. It is the prepaid card instead. Think of it as like a gift card that you get to decide how much money you want to put on. And this we thought would be more secure than a debit card, because if you have the individual who has the card, but someone else is managing the account, the account manager doesn't have to worry about the individual accidentally spending everything that's in the account. Also, if you happen to lose your card, they can't drain the whole account. They'll only have, there's only the amount that you've chosen to put on there.
Okay, so here's a little more specific question. So when do you need to get a signature guarantee when you're moving funds from like a college 529 to the ABLE account, or more specifically, a medallion signature guarantee?
So was that why or when?
When?
Okay. So yes, when you're moving it, the paperwork says that they want a medallion signature guarantee, which is like a step up from notarization, and you can get that at your bank. But feel free to email me. If you are moving money from the Oregon College Savings Plan into Oregon ABLE, we might be able to waive that for you. But if it's a different 529 that's requiring it, you can still email me, but I'm not as confident that I can help with that part. But yeah. It's just a security measure that's built in, but I know that it can be a bit of a pain.
Okay, so is it the parent's responsibility to report to the to SSI that a person has an ABLE account?
That is a great question. Um, So when you are talking with Social Security, it is good to mention that you have this account, but you don't have to do any additional reporting to them. We actually give Social Security a limited amount of information each month. So we say who has an account, how much went in, how much went out.